Hi, I'm Bob Keiser, Vice President with Global Markets Intelligence Research at S&P Capital IQ. Thanks for previewing the September 20th edition of the Lookout Report. The Federal Reserve surprised many market participants this past week when the FOMC announced that it had maintained the pace of QE3 asset purchases at $85 billion per month. To some extent, since a 10 to 15 billion tapering already appeared to be priced into the financial markets, the commencement of some tapering might have actually been the easier decision for the Fed to agree on. But in the end, the Fed decided to surprise many in the market by postponing the inaugural reduction in open market security purchases. GMI Research fully understands the Fed's decision to sit pat at this point in time. Since the start of this year, the Fed has repeatedly stated that it would commence tapering after concluding that the outlook for the U.S. labor market had improved substantially. So the question surrounding the initiation of tapering boils down to how do you define a substantial improvement in U.S. labor market conditions? While the U.S. unemployment rate at 7.3% as of August is clearly on a trajectory towards 7% or lower in the months ahead, there are other labor market-related economic indicators that fall short of illustrating a substantial improvement in labor market conditions. The U.S. labor force has shown negligible to non-existent growth since the fourth quarter of 2012 when QE3 was announced, placing artificial downward pressure on the unemployment rate as some individuals become discouraged and exit the pool of available workers. Mostly due to cumulative downward revisions to non-farm payroll data released earlier this year, we've also seen the 3-month average rate of payroll growth decline from as high as 200,000 as recently as April to 175,000 heading into the August employment report, which now stands at just 150,000 after the latest jobs report that also included substantial downward revisions to the 2 prior months' data. So after considering labor force-related issues, the decline in U.S. unemployment rate is not as substantial as headline numbers might suggest, and following months of net downward revisions to previously released payroll numbers, the pace of non-farm job creation is not quite as substantial as what was previously indicated. GMI Research believes that while tapering has been postponed, it is still fully the intention of the FOMC to completely wind down the QE3 program by the end of 2014 at the very latest. Market participants will be closely following high-profile U.S. labor market economic indicators for clues on when tapering will begin, and then more importantly, how it will likely proceed. For information on why GMI Research will also be closely following U.S. housing starts data for clues on when the Fed will resume the countdown to tapering, which is likely to continue influencing the level of U.S. interest rates, see this week's edition of the Lookout Report titled, "The Fed Tiptoes Around Tapering." Until next time, I'm Bob Keiser with Global Markets Intelligence at S&P Capital IQ.